The Federal Reserve seems to be clued in that there is a collateral shortage. Over the last several months, they have been commenting on it, including a lot more lately. We're going to talk about that and what it might mean for our economic recovery. But first, before we do, ladies and gentlemen, did you know that this segment of the show is sponsored by Jeff Snider's recent appearance on The George Gammon Show? Yes, yesterday, July 22nd, Jeff was with George talking about all manner of things, though in the first 15 seconds you would think it was about showers. Yes, George Gammon said he was thinking about Jeff while in the shower. Where does the show go from there? It says here, reverse repo deep dive, mind-blowing intel on shadow banking risks and why Zoltan's wrong. But I don't know, because I ripped out the computer and I threw it violently against the wall when I heard that, so I don't know what the rest of the show was about. Jeff Snider, welcome to the show. Did the show improve after? No, it got worse. It can't possibly be.
Yeah, I'm not sure. What is it we used to say last year? You've left me speechless. I think that introduction has definitely. The problem is, though, it's true. There was shower talk with George before we talked about Zoltan and reverse repo and cash and collateral and all sorts of things. And, it was a very good discussion. I think it's worth everybody's time.
I regret spending money on this webcam because it's high definition and so you can see me blush. Oh, man. I loved it, George. Good. More shower talk from George Gammon. All right. No one's here for that. They're here for a discussion about the Federal Reserve seeming to be clued in about a collateral shortage. We're going to dial it back a little bit to February 23rd. Now, a lot of people don't know this, Jeff, but you were asking that day the chairman, Federal Reserve Chairman Jerome Powell, you were asking him a question indirectly. He was testifying and you were asking him. Let the audience in on this incredible story.
Well, I was asked for some input. Some people who were working with Senator Steve Daines of Montana, who was preparing for Jay Powell's Humphrey Hawkins testimony on February 21st, and they said, you know, let's slip in a little question here about T-bills and collateral and what's going on there. And so we put together a question, put it in front of the chairman, and I think, you know, when you see the body language he shows after hearing this question, he wasn't prepared for T-bills, collateral, whatever. I mean, and so he didn't really answer the question. Not that we expected that he would, but he sort of gave an answer that, you know, there's lots of cash out there and these standard kind of boilerplate stuff that Fed chairmen always do. So he was asked T-bill shortage, collateral, are you concerned? And, no, we've got everything covered. You know, tools in the toolkit kind of a response.
Let me read what Senator Daines said. Quote, I was just looking at the T-bill chart and noticing since the 1st of February, the 1-month rates have dropped in half from 0.6 to 0.03. 2 months went from 0.7 to 0.2. We're starting to get into that realm here of possibly negative rates, which we saw, of course, briefly a year ago, March. Just want to get your thoughts on that. Is there any issues here of a shortage of collateral? Incredible. When I read that, I couldn't believe it. I was thinking they're watching you, but then you'd fill us in that you helped out. What's driving this as you're watching some of these short-term rates approaching zero? Here's what Powell responded with. So with the T-bills in particular, this would really be a Treasury issue, Janet Yellen. But I would say it's a lot of demand for short-term. There's a lot of liquidity and people want to store it to some extent in T-bills, and there's demand, and therefore that drives down the rates that people are being paid or receive for buying those assets. From our standpoint, our policy is the federal funds rate. So, yeah, I'll let you go into it, Jeff. And to the extent there were to be downward pressure on that because of, for example, the Treasury general account shrinking in size, then we have the tools that we can use to keep that rate in our intended policy range. Jeff, it looks like he is sending everything to Janet Yellen and the Treasury Department. Is that true? And then fast forward to last week, or is it now 2 weeks ago, July 12th or so. What did he say then, and how has his response changed?
Well, first of all, I mean, look, I think, let's back up a little bit and talk about what he said with federal funds, because that is how the Fed operates and how it views monetary policy. And you got to think, hey, what is Jay Powell actually saying here? He's actually telling you how monetary policy operates, and it's not about money. What he's saying is, look, we move the federal funds rate around. Well, actually, we don't even do that. We actually move the target range that we allow the federal funds to move within. We influence the federal funds market, and what does that do? Well, that signals to the public whatever message we want to send to the public. So we don't care about the plumbing. We don't care about collateral necessarily, unless it impacts the federal funds rate, which then maybe interrupts or complicates the message the Federal Reserve is trying to send to the public, because this is about psychology. It's not about monetary competence or monetary conditions. It's about, can we use the federal funds rate to signal to the public and the employers and consumers and investors, financial services professionals who want to buy stocks at every bit that they can we properly signal to those people? And the only way we even care about treasury bills or collateral is if maybe the money markets get messed up, and that dilutes or impedes our federal funds signal. That's really what Jay Powell was saying. Maybe there's a lot of demand for treasury bills, but we don't care as long as it doesn't impact the federal funds rate.
And then fast forward a few months to June. What month are we in? July. And he was asked something related, but not directly related. Now he was being asked about the surge in the reverse repo program that the Federal Reserve has, that we've talked about before many times, and that you just talked about with George. And he was asked, and his tone, was it different? Was his answer different? Is this related to our first question? His first question?
As you just pointed out, Emil, the first question was sort of, okay, is there something going on in T-bills and collateral? And he said, there's demand for liquidity. There's lots of cash. That was the implication. This time he was asked, what's going on in the RRP? Is there too much cash? And he was asked by, I think it was Congressman French Hill from Arkansas. And he's basically asked the question almost taken from his last response in February. Is there too much cash? Is that why we're seeing the reverse repo go up? And he said, no, there's a shortage of, I forget how he worded it. It was kind of weird.
You could say there is a shortage of safe assets. So yeah, that's why that's happening. There's a shortage of T-bills, not a lot of T-bills.
So also he went before, there's lots of liquidity, too much cash, and demand for treasury bills. And now there's not enough treasury bills. That's a completely, in a lot of ways, it's a 180-degree opposite take on the answer. And so what changed between the end of February and the middle of July? Well, the obvious answer is the reverse repo. And the reverse repo is the reason that most people are even talking about any of these things, because it's such a big number. We're talking about 800 and some odd billion, it's hard to ignore that kind of a number. The problem comes in where most people don't understand what's going on here, because federal funds. We're taught from the very beginning, let's focus on federal funds, let's focus on the Federal Reserve, and leave all this other stuff to somebody. And we're just assuming, and most of the public assumes, that somebody is the Fed, when you can see from the history of the last 40 years and even longer, last 60 years and even longer. I mean, you can go back to the beginning of the Fed really doesn't ever have a really good idea of what's going on in the monetary system. And that's especially true and especially obvious going back to August of 2007. So, we have this mismatch in the minds of the public where we see these things are going on, but we don't really know what's going on, because we're supposed to pay attention to the federal funds rate, which, if you pay any attention, the federal funds market itself is completely, utterly, irrelevant. There's nobody there. The federal funds market is a tiny drop in the bucket, but the Fed continues to focus our attention on it because they want you to believe all of these myths, that they have everything under control and that the federal funds rate is the only thing you should worry about. And there's all this other stuff going on, but we've got it covered. That's the tools in the toolkit line. Don't worry about that stuff because we've got it covered. Where behind the scenes, they're all sweating bullets because they know they don't have it covered.
It's funny, it made me think of, they're so focused on LIBOR, right? Behind them, they've got their own rate, the federal funds rate, which should be the number one concern. Why is there nobody in this market? And then But nobody asks them. And instead, they're saying, aha, LIBOR, look at LIBOR, look at that thing over there. What? No, nothing here.
We've got to eliminate it. No competition.
I don't want to do a tangent. So moving on to an essay that you wrote last week, July 16th, at Real Clear Markets. It's called Why Don't Bonds Reflect CPI Alarm About Inflation? This is going to be like part 2 to episode 89A that we've already done. So audience, if you're enjoying this, check out that episode first. And in that essay, you alert us that not only is Mr. Powell thinking about collateral, shortage of safe assets, not only is this question been coming up, but some researchers at the Liberty Street Economics blog, which is the Fed's New York blog. There you go, I said it. They wrote about this, Jeff. Well, kind of indirectly. They wrote about collateral and U.S. Treasuries and what happens in the early morning hours. How do we tie that all in?
Well, what they were really focused on was a report that was written by the Treasury Department's Office of Financial Research, who took a sort of deeper dive into the repo market as a whole. Well, I shouldn't even say that, because they took a deeper dive into one big part of the repo market, but not the whole. They got the access to confidential information from DTCC, the FICC part of the repo. They didn't get into tri-party repo, which kind of surprised me. They looked at some GC repo, but they left the majority of repo, which is bilateral bespoke, which is stuff that doesn't hit any tape anywhere, obviously outside of their survey, because there's really no way to survey what goes on between two counterparties that don't disclose their transactions. So they focused on a part of the repo market, but it was a big significant part, using data that nobody else can have access to try to get a sense to how does this repo market actually work. And what they find, I mean, there was several different conclusions, but narrowing it down to our interest and what we think is relevant here, the Office of Financial Research, as discussed by the Liberty Street blog, said, well, isn't this weird? We keep finding in the early morning hours that most repo transactions get done before the U.S. market opens. So usually by 8:30, 9:30, most of the repo stuff is already finished and it's done for the day, which causes some potential issues. And among those potential issues is something we've been talking about for a very long time, which is what they called in the Liberty Street Economics blog. It wasn't clear to me whether the OFR actually created the term, and it doesn't really matter. But what they said was there was this obvious, or at least apparent, scramble for collateral as these pre-market repo repo segments wind themselves, as they get really busy and active, getting the day's fundings arranged before the U.S. market opens. We can observe that there's these scrambles for collateral. Now, what they said was, oh, that's too much cash. There's money market funds that are unable to access repo market borrowers who have sufficient collateral. Therefore, it leads to everybody just piling into various forms of collateral and collateralized lending. And that's where, again, it's understandable they would make that connection, because they don't really understand what they're looking at.
Yeah, here, let me read it. And you draw our attention to two phrases. Here's the first one. More recently, repo market participants have highlighted an early morning scramble for collateral due to an overabundance of cash. This imbalance has several drivers, including less interest in cash borrowing by levered accounts and thus providing collateral, the continued increase in cash availability amid money market fund inflows and rising aggregate reserve balances and Treasury bill paydowns. This has resulted in an increase in more early morning and negative rate trading, as dealers are willing to incur negative cash lending rates to obtain collateral. Indeed, negative rate GC trades throughout the first quarter occurred earlier in the daily session than zero or positive rate trading, as shown in the next chart. What should we take away from that, Jeff?
So yeah, they're saying, look, we've seen some scrambles for collateral this year. It must be an overabundance of cash, because that's our worldview. What else could it be?
Well,
we're taught and we believe that, you know, bank reserves are money. There's an abundant, we're in a regime of abundant reserves. Therefore, we have to explain everything via reserves. And so from their perspective, they're looking at all this stuff, and they're coming to a conclusion from their worldview or their ideology, where if you step outside of that and say, scramble for collateral, early morning, repo, this isn't just a recent thing. And we'll get back to the recent stuff too, but this is not just a recent thing. We observed this, and I documented it in real time last March. You could see during the March 2020 crisis, this exact thing happened. You could see it in T-bill rates that would suddenly plummet, especially beginning with Asian trading. And you would say, what is going on here? It's not an abundance of cash. It's certainly not an overabundance. And you'd see it in gold markets where you see gold slam. And we've talked about this, for years, that the relationship between gold and collateral shortages and all that kind of stuff. So it was pretty obvious in March 2020, this scramble for collateral, early morning repo problems settling that would then lead to problems in the rest of the day where you'd have liquidations in stocks even. So it was, connect the scramble for collateral, lack of liquidity across multiple markets all around the world, not an overabundance of cash, leaving the system into a precarious state of, essentially one fire sale after another, essentially a monetary crisis. And we talked about before how the Fed views itself as lender of or market of last resort, which is a complete change, where a proper central bank would have been more interested in preventing these fire sales and liquidations, which then ties in with what we just talked about, the federal funds rate being nothing more than psychology. Because when you put all of these things together and view bank reserves properly within that review, what you see is that these people aren't monetary. They don't do money. They do psychology. The Fed is not a central bank. And if a Fed is not a central bank, you got to look at bank reserves rather differently. Which brings us to 2021. We've observed these scrambles for collateral, as the New York Fed, or as the OFR has said, but how do we tie them to an overabundance of funds? It's kind of difficult, especially since late February when things have changed, and in mid-March where we start to see the spike in repo. At the same time, long-term treasury rates are coming down in a deflationary signal that you just would not associate with an overabundance of cash. You would think an overabundance of cash is probably inflationary. At the very worst, it wouldn't be deflationary or disinflationary, right? So again, we're left wondering, what is it we're missing here? And the answer is, well, pretty much everything that matters, everything that's important.
If the audience wants to read this blog post, you can find it at Liberty Street Economics, posted on the 14th of July. The title is Intraday Timing of General Collateral Repo Markets. And Jeff, they offer scramble for collateral as their number 3 explanation. Number 1 was, quote, the factor that market participants most consistently cite is the start of daylight overdraft fees assessed by clearing banks at 8:30 to dealers that have not funded their clearing accounts. The number 2 reason they cite, repo market participants also look to trade during the most liquid and active portion of the session, driving further activity to the early portion of the day. And then here at the end, I found this part really fascinating. They said, additionally, repo market contacts have highlighted an increase in the amount of repo trades being arranged prior to the market formally opening at 7 a.m. The collateral scramble, Jeff, is so real that we're doing it off hours. We need to take care of this before we even get to the market, because I can't risk fighting with everyone else for this collateral.
Yeah, and I think that one of the things they left out was that, again, as I point out, Asian, European trading, those things are going on, and yes, the U.S. dollar and U.S. dollar funding markets are extremely important to them. There's this American U.S. dollar domestic bias at work here, where even here they're forgetting about the fact that when you saw, especially in March of 2020, T-bill rates fall in the early morning. I'm talking 1, 2 o'clock in the morning in rather thin trading, but still, that's when Asians were short of Asian trading partners were very short of dollars, scrambling for collateral that kicked off all sorts of other things that triggered through the European session and on into the pre-market U.S. Open, which is where all this stuff kind of sort of comes to a head that 7:30, 7 o'clock, 8:30 sort of window, where yes, that's right. You can't face the U.S. regular trading session if you don't have your funding in place for the day, or at least the anticipated funding in place, and you can't have the funding in place if you don't have the collateral. So, looking at it from the perspective of reserves and the federal funds and all that kind of stuff, you're missing out or just the domestic system, you're missing out on, I think, connecting a lot of these dots in order to make a comprehensive, consistent picture of what must be going on.
You bring up the foreign markets, the Asian markets, in real time in this next article we're going to look at, and we're going to observe what the Liberty, oh God, I keep messing it up, Jeff. What's the name of this blog? Liberty Economics?
Liberty Street Economics.
Sweet God.
It's Liberty
Street Economics.
The New York Fed's branch is located on Liberty Street in Lower Manhattan. And to me, that's, we don't need to get into it, but I think it's one of those, intentionally disingenuous labeling.
Good, yeah. No, I'm off my game, Jeff. I'm off my game. Let's see. So, getting back to your work. Real time, you talk about it in a blog post at Alhambra Partners. You posted on the 20th of July. Here's the title of it. Sorry, one more on bills. Today, a really good example of all the things we've been focused on lately. I'm going to pull up some charts, Jeff. And at one point in your article, you say the previous day's bad things in highly bid U.S. Treasuries had stabilized overnight until around 4:40 a.m. And then you say Asia. An exclamation point. So tell us what we're looking at here with this, not this. Yeah.
There it is. Yeah. Well, let's back up a little bit to remember what happened on Monday. Monday, which was July. The date escapes me, but it was earlier Monday. Would have been the 18th, 19th. Okay, so the 19th, Monday the 19th. Remember, big downdraft in global bond yields, especially U.S. Treasuries. The 10-year Treasury fell something like 12 basis points on the day, which is, again, not consistent with an overabundance of cash, right? We're not talking about an overabundance of money here. We're talking about an overabundance of concern and caution about possible deflation. So
our audience has asked me if that was a collateral day with respect to episode 89A. And you said no, I said no on Twitter. It needs to be sharper, longer.
Yeah, there needs to be more panic in the buying. It was sort of a steady buying during the day. And, 12 basis points by the end. I mean, I would expect something like that to happen. You'd see 12 basis points in a matter of a couple hours, not necessarily across the other day. So it was kind of getting into that feel, getting into that range. And it, for a while there was like, yeah, maybe, but no, I didn't really. And this is more of a term of art. There's no quantitative thresholds here. And if other people want to view it as a collateral day, they're more than welcome to. And it may turn out down the road we go look back and say, yes, it was. But just my humble opinion, I don't think it took on quite those proportions. But it definitely was a day where you sit back and say, this ain't good. Something not right here. It's not an overabundance of cash. It's an overabundance of deflationary concern. So that was Monday. Monday, we had a downdraft in yields, deflation, bad stuff, bad potential. And then things kind of stabilized overnight. If you look at the overnight Treasury market, Treasury yields kind of backed up a little bit. They off of their low points, and they moved up a little bit. And they were stable until around, what was it? I think 4:40 a.m. Yes. So right toward the end of Asian trading, as Europe's coming on, all of a sudden the 10-year Treasury yield began to drop again, and it dropped pretty precipitously in this early pre-morning trading. So again, continuation of not just Monday but the Friday before, caution, deflation, bad things, and then bam, right at 6 a.m. on the dot, you can see it on your screen right here. It's so unbelievably obvious. That's why I said it's probably the most perfect example of scramble for collateral, whatever you want to call it. It doesn't get any more obvious than that. The 4-week bill yield, which is about 4.5 basis points, let's say, within about half an hour, it was down near 2. And I think in some secondary pricing models, it was down closer to 0. Obviously, huge demand right in this window that we're talking about. Liberty Street Economics blog saying early morning repos coming Early morning scramble for collateral. But as we just finished up saying and talking about with the long-term treasury yields, how do we associate this with an overabundance of cash? We have caution in the early morning. We have bad things going on the previous day. And then all of a sudden we have this massive scramble for collateral that looks a hell of a lot like last March. Now, I'm not saying it was in those kinds of proportions, but it was far more. This entire episode shared far more in common with last March than any idea of overabundance of money.
And that's the takeaway from your last article that I just referenced, that the worst is still ahead of us if we continue down this path that we've already traced out 3 times or so before, or 4. And this is just another warning that we're on a deflationary path, not a reflationary one. Do you have any concluding thoughts?
The logical concluding question is, well, if this was such a bad scramble for collateral and bad things were happening, why didn't it lead to liquidations, widespread liquidations and crisis and all those other things that happened last March? What is the difference here? Because we're talking about something that was such an obvious disruption in the marketplace. You can see it on every single chart, right? All the bill charts and all those kinds. I mean, it's obvious scramble for collateral, but why didn't it lead into? Because if you remember Tuesday morning, once the U.S. market opened, everything it was sunshine and rainbows. Markets were up. Even T-bill rates rose. The 4-week T-bill finished the day above 5 basis points that particular day. So what we take away from that is that, again, I think that's why I said that Monday was not a collateral day, because the system isn't quite that bad. It's in a precarious state, but it hasn't crossed over from precarious into critical. And that's why we're looking for these kind of big warnings. A collateral day, JGB 10's going under 0, which they keep flirting with the 0 line. And there's a number of other ones that we could say, okay, we've crossed from things are precarious to things are really serious and critical. And I don't think we're quite there yet. We haven't seen all those things. So we had a serious episode in collateral, which is consistent with this deflationary potential, precariousness, but it didn't go any further, because we're not over onto the wrong side of things into this is really bad, dangerous. The system is really in really sorry shape. We aren't quite there yet.